So Ron Wheeler has more than 17 years of experience as a trader and a trading educator since beginning his career with Tom Joseph, the creator of Advanced Get. He has worked with thousands of traders from beginners to seasoned veterans all over the world on topics from building new trading plans to advanced topics such as Elliott Wave and GAN. He currently specializes in day trading and short-term swing trading, various markets such as the E-mini as well as the equity option trading, utilizing both Elliott wave analysis and GAN theory, and has experience in trading a wide range of markets from Forex to grains across many time frames. Today, he'll be showing us a simplified approach to Elliott wave analysis. Ron, it's all yours.
All right, thank you for the introduction, and thank you again to Real Traders webinar for hosting today. Welcome everybody. My name again is Ron Wheeler, and my current position with eSignal is I'm one of their trading mentors. So what I'm going to show you today is a system and really a strategy concept that I use every day in my trading. Whether I'm doing 3-minute charts of the E-mini, 5-minute charts of the E-mini, the Euro, if I'm trading Apple on a 15 and I'm using options for that, it doesn't make a difference. I'm using this type of analysis. Now, we have an hour, so I can't, of course, show you everything in the arsenal in a very, very detailed format. So it's going to be more of a, a 30,000 feet view approach if you kind of get my meaning. I'm going to show you the basics of how the advanced get system works. Now, the advanced get system, just to give you a little background on that, this system's been around since 1987. It's been around for a long time. I personally, as in the introduction had said, I've been trading this since 1997, so I've been using it for a long time, and I've done all different types of markets with this. So one of the bigger questions that I always get in these presentations is, Ron, does it work with currencies? Yes. Does it work when I day trade, stocks like IBM or Apple or Priceline or Google? Yes. Does it work with, corn and wheat and copper and things like that? Yes. Everything that I'm going to show you today is universal to any type of market pattern or any type of market that you trade. Really, what you can do, you can just forget about the fact that I'm looking at a 30-minute chart of NextEra Energy. You can take the prices off the screen, because as I get through my definitions of how the Elliott systems work and how you can trade them, we're going to take a look at all different types of charts. And I'm also going to take you into our system where we can scan for these different types of patterns and behaviors. So we can let this system find the trades for you as the markets are trading. Now, to give you a very brief understanding of how Elliott wave works. Elliott wave, in my opinion, because I've been doing it for a long time and I've been teaching it for so long, it's a very misunderstood trading system. There's Elliott wave analysis, first off. If I ever get the question in a class saying, hey Ron, what do you think the market's going to do this year? That's Elliott wave analysis. I can look at a monthly chart of the S&P or a weekly chart of the S&P and give you the current Elliott wave analysis on that chart. Hey, it's in a wave 3. It looks like we can extend even further. Maybe the wave 4 is coming, and I can show you a 25 or a 38% retracement. There's Elliott wave for analysis purposes of trying to see long-term what the market's going to do. I specialize in. So a lot of things that you see on my charts and a lot of the definitions and descriptions you hear me talk about may kind of not coincide with things that you've heard about Elliott over the years. One of our biggest claims to fame, if you will, is our Elliott wave may not jive with traditional Elliott wave. What our goal and what our objective is in our Elliott wave analysis is to get you into a position that you can trade. You know what? If I can go back in 1980 through 1990 and show you all the perfect Elliott wave sequences 10 years ago or 20 years ago, hey, my analysis technique is great. But if I have to wait 10 or 15 years into the future to show you how great my predictive skills were, you can't make money off that. I can't go back to 1987 and buy a low. I can't go to 2001 and sell a high. We're way past that. So I need to take that predictive nature of Elliott and turn it into a practical system. So a lot of the things that you see on the chart, if I go back in time, may look a little bit different back there, because my goal is to get you into a tradable sequence at that time. If the market rallies or sells off or goes sideways and that changes the complexion of the Elliott wave model for that chart, I don't care, because my goal is to get you into a profitable position at the time. It's not about what happened in the past. It's about what's happening right now. And that's a practical side of Elliott. Now, In saying that, let me give you a quick idea of how Elliott wave and what the Elliott wave theory is. The Elliott wave theory, simply put, is a 5-wave model or a 5-wave sequence of trending behavior. This is a 30-minute chart of NextEra energy, and what I want you to focus on the most, I want you to focus on the big blue circled numbers, and I'll draw little arrows to them. You know, this number here is wave 3, this number down here is your wave 4, up here is your wave 5, the big blue circled numbers. The general Elliott theory states that a market will trend in 5 waves. Once the 5th wave is complete, we will generally see either a major correction, which basically means this is a 30-minute chart of NextEra. NextEra could sell off from 102, theoretically, all the way down into the 90s again. Just like we saw back here at 11 o'clock in the morning on June 11th. NextEra reached a 5th wave low, the market stopped selling off, and it rallied from $94 to about 102 over the course of, about 10 days or so, 10 calendar days. So again, the general Elliott theory is that a market will trend in 5-wave sequences. Once the 5th wave is complete, the market has a tendency to reverse course. It'll have a major sell-off or a major correction of some sort or a complete change in trend. Now, what we did back in the 80s with AdvancedGet, we ran, this is even before the software was out, in the building block stages of how AdvancedGet was put together. The numbers were crunched. Tore apart the Elliott wave sequences, waves 1, 2, 3, 4, and 5. And what we tested and what we back tested was how these systems and what systems were more appropriate for predictive trading. Because I can tell you, in real time, there are certain elements of these 5-wave patterns that are predictable as they are occurring, not just after the fact. They're predictable as the market is trading. And what the research showed was waves 3, 4, and 5 are your most predictable Elliott wave sequences, 3s, 4s, and 5s. Now, one of the first things, in my opinion, that you have to get used to and you have to be comfortable with as a trader, you are not going to be able to get every single market move. Being a trader revolves around the idea and the acceptance of there are going to be certain points in the market that you can predict patterns on. There's going to be certain times in the market that you can't. You have to be comfortable with looking at a market and watching a market make a move. And sometimes that move can be dramatic. You might watch Apple, and Apple rolls $2 or $3 a share. And that thing is moving and moving and moving. And you're sitting there scratching your head saying, my God, what caused this rally to happen? I don't know. From a technical standpoint, I may not know. That happens. But if it moves up another $1.50 after that, and a pattern comes that can predict that, that's what we're looking for. There's going to be times in markets that you are left scratching your head saying, boy, what caused that to happen? And that's okay. That's part of the acceptance. You have to be ready for what can be repeated and what patterns are seen over and over again. It's not trying to get every single market move. It's about what's repeatable over time. And that's what I'm trying to focus on here for the Elliott concepts. It's not about trying to catch every high, every low, every retracement, every time there's a rally, every time there's a decline. It's about what can we see with a certain degree of predictability to focus our trading on. Okay? I always tell my students there's 3 things that you have to get used to as a trader. You have to get used to being able to buy something, you have to get used to being able to sell something, and number 3, you have to get used to being able to doing nothing. There are going to be times when the best trade is to sit on your hands and not do anything. Okay? So when I say the best trading sequences are 3s, 4s, and 5s, this is what we're going to concentrate on. If the market is in any other sequence, we're going to leave it alone. We're going to wait for those predictable 3, 4s, and 5s. Now, one of the most predictable Elliott sequences that you will see is an Elliott wave 4. Okay? An Elliott wave 4 is a pullback trade, what we call a continuation trade. We're going to wait for that market to be in a rally or a decline, because a wave 3 can be up or down. Okay? And you see it right here. The wave 3 is typically your strongest trend of the market. I'll just kind of draw an arrow on what I'm referring to here, wave 3. Wave 3 is right here. Okay? Wave 3 is typically the strongest trend of the market, the biggest move. Wave 3 is a predictable wave sequence. Now, wave 3, if I can use a baseball analogy here, wave 3 is the home run. It's the big one. It's the long ball. Usually in baseball, before the steroid era, of course, your home run hitters were low percentage hitters, but they hit a powerful ball. So they might hit 260, 250, 270, but they hit 50, 60 home runs a year. Okay? It is a low accuracy, high reward trading sequence typically of wave 3. You need to know that going ahead of time, because if your goal as a trader is to try to find a bunch of wave 3s, you need to know that you're going to have a lower degree of predictability, but ultimately a higher reward. Now, a lot of traders can't deal with that. A lot of traders can't deal with low predictability and taking 3 or 4 losing trades and then having one winning trade pay for all the losers and give you extra money aside. That's a mental thing that you have to kind of get used to. So if that's not your mentality, that's okay. There's other trading sequences that we can take advantage of that are a little bit more predictable. Now, once the wave 3 starts, this is big. This is a key moment in market timing. Wave 3 is the significant trend of the market. Once that trend starts, everything starts to fall in place as far as predictability. Now, when that wave 3 ends, these numbers, by the way, these Elliots that you see on the chart, the big 3, the 4, and the 5, these are not just random numbers that appear on a chart. Okay, Elliott wave is not random. Elliott wave numbers appear because the market is following a very distinct Fibonacci sequence. So if I take a look, and I go back to my wave 2, which was back here around 10 o'clock in the morning on June 12th. If I measure that, your wave 2 is typically from a Fibonacci scale around a 62% correction of your wave 1. So if I measure from the beginning of wave 1 to the end of wave 1, we'll see that my wave 2 is roughly right around 62%. Okay? My wave 3 is typically a 160 to 260%, but in some cases it can go even all the way to 425%. Now what that means very clearly or very easily is my wave 3, if I measure the length of wave 1 from the beginning to the end, my wave 3 can sometimes extend, like it did in this case, to about 400% the length of your wave 1. Take a look at where that wave 3 ended up here on June 19th at 9:30 in the morning. It was a 425% extension of my Elliott wave 1. Okay, and that's where wave 3 finally terminated. Now, where wave 3 terminates, this typically begins our first major profit-taking phase of the trend. Now, during this wave 4, we're up here in wave 3. The market is starting to pull back into wave 4, okay? This is an area as a trader that I expect you to sit on your hands. If you're a trader that's taking advantage of wave 3, okay? Now, first off, I want to just kind of make sure you understand we're talking about general market concepts here. I haven't even talked about how to actually enter the trades or what triggers we're looking for, indicators or anything like that. I'm just talking base Elliott analysis right now. We're going to trade wave 3. We're going to try to get into that phase in the beginning areas of the trend. Okay, that's the wave 3. Once that wave 3 is reaching its ending point, we know it's reaching its ending point because it's hitting some of those key fib numbers of 1.6, 2.6, 4.25, etc. Once we take profits on our wave 3, we are going to sit out the profit-taking phase. We're going to take that profit-taking phase of wave 4 and we're going to sit on our hands and do nothing. What we're going to wait for is we are going to wait for that wave 4 to complete right here, and we are going to jump back into the market in anticipation of that last 5th wave rally. Okay? Now, for those of you that like to take trades with a higher degree of accuracy, with a little bit lower reward, the wave 4 is for you. We have a trading system around the wave 4 called the Elliott Type 1 trading opportunity. The Type 1 trade historically is a successful trade about, upper 50%, 60% of the time with good money management. It's a higher degree of predictability with a smaller window of profits. Now, the smaller window of profits, we're still looking for a 2-to-1 return. So for every $100 you have to risk, we're still anticipating a $200 return on that, but it has whereas the wave 3 might be 4, 5, or 6 to 1, the wave 4 has a smaller profitability window, but a higher degree of success. Okay, that's trading the wave 4. And again, just so we're on the same page, wave 3, we're going to look to enter into the market. Wave 4, we're going to sit out the retracement, and then we're going to rebuy when that wave 4 reaches its conclusion and that wave 5 starts. As that wave 5 starts back up, at the end of wave 5, and I'll actually show you here a few examples as we go forward, how do we know when wave 5 is terminated? Well, we can do basically the same concept. Wave 5 typically ends at a 62 to 100% extension of your waves 1, 2, and 3. So wave 5, right now, if you look at Nextera, we're not close yet. Well, we're kind of close. We're not exactly at the end of wave 5 yet. Wave 5's target is about 103.04 to about 105.57. So what I would do in a case like this is I would have a trailing stop in place, whether you use something like a moving average, something like a parabolic, some sort of a trailing stop to keep your profits protected if this market comes down early off of a support or resistance level. Okay, because if we bought into the market back here at around 99.50, this stock's at 102. I certainly don't want to give back profits at this point. All right, so at the end of wave 5, what we would do is we would prepare to now start going against the trend. Typically, your trends terminate on wave 5, so what we're going to do is we're going to prepare to exit the trend altogether and now reverse our positions if we want and now start a new downtrend. Okay, that's a big thing if you're a trend-based trader. Everybody out there hails the concept of the trend is your friend. The trend is your friend. It's been ingrained to you as a technical analysis probably since the beginning. The trend is your friend. And you know what? It is. The trend is your friend. There's just no contradictory evidence against it. The problem is the trend is your friend until it ends. Once that trend terminates, then it's no longer your friend. And what can happen, and I've seen this happen over and over again, is traders will continually, as the market starts selling off, they're going to try to rebuy and rebuy and rebuy as the trend is terminating and going in the opposite direction. What Elliot gives you as a trader is it gives you an idea of where we are in the trend. Are we in the initial impulse wave of wave 3? Are we in a profit-taking wave of 4 where we know this thing's got some left in it? Are we at the end of the trend in a wave 5? It gives us an idea of where we are. And that's the key. We need to know where we are. All right. Now, how do we do it? How do we trade this? We know the base patterns. We know the concept behind 3s, 4s, 5s. How do we actually trade this type of market sequence? In AdvancedGet, I'm going to expose you to 2 trading strategies right off the bat. The Elliot Type 1 trade and the Elliot Type 2. The Elliot Type 1 trade revolves around catching the end of Elliot Wave 4. The Elliot Type 2 strategy revolves around catching the end of Elliot Wave 5, where it's preparing you to move in the opposite direction. Okay? Now, the software that you're seeing in front of you, this is eSignal version 11. One of the releases, 11.7, okay, using the AdvancedGet system. Now, eSignal has a great tool in here called training mode or replay mode. I always refer to it as replay mode. Some people refer to it as training mode. What I'm going to do is I'm going to step back on this chart and step back in time. I'm going to bring this chart back to around 11:30 in the morning on June 23rd. This is what Nextera looked like the morning of the 23rd. Okay, right around 11 o'clock, 11:30, late morning. Now, this is what it would look like, by the way, in real time. This isn't, going back and changing things. This is what it looks like in real time. The Type 1 trade is a mechanical trading system. That means there's rules that you follow. Rule number 1 of the Elliot Type 1 system is the market has to be in an Elliott Wave 4. Well, you take a look at your chart. The last labeled wave is an Elliott Wave 4, and there it is. Right there, clear as day, it's an Elliott Wave 4. Now, the biggest tool that we use for Elliott Wave analysis in AdvancedGet is the study that you see in the bottom of your chart. It's called the Elliott Wave Oscillator. Now, this oscillator, all it is It's a price oscillator. It's the difference between two moving averages, a 5 period and a 35 period. Simple moving averages, it's a price oscillator. A lot of people look at this and say, why did you use a 535? You know, isn't that like a MACD? Isn't it the same thing? Why why do you use that? It's not so much why did we use it. We didn't come up with this number off the top of our heads. We did a lot of studying, a lot of testing to see which oscillator matched the concept of Elliot's teachings. Elliot's teachings talked about wave 3 being a great period of strength in the market, wave 4 being a retracement or a profit-taking phase of that strength, wave 5 being strength but not as much as previous waves. Okay? The Elliot oscillator, like we use it, matches, and in testing showed it to be the most accurate level to predict and help us identify repeatable Elliott sequences. So why didn't we use the MACD? We tried. Why didn't we use a 10-15 oscillator or a 10-100? We tried. Trust me, we backtested all those. The 535 worked the best with this Elliott model. Now, if you go back, and I'm paraphrasing here, I'm not, reading Elliott by the book here. If you go back and kind of paraphrase some of Elliott's teachings, he talked about wave 3 being a very, very strong sequence. It's strong market conditions. The problem with strong is subjective. What may be strong to me may not be so strong to you. What may be so strong to a trader over there may not be strong to the trader back there. Strong is a subjective term. So what I need to do is come up with an indicator that makes it objective. It's either strong or it's not. So when I start seeing wave sequences like wave 3's form, I want an indicator that lets me know that, hey, this market is strong. The oscillator does it. Now let me do this real quick on the oscillator. I'm going to thicken that band up on top so it's easier to see. That black band that I just thickened up, this is a breakout band. Okay? The breakout band is essentially moving average based, and what that breakout band will do is it gives us a level of strength. So if I see the oscillator like right here, here's my wave 3. During the wave 3, if this oscillator breaks that upper band, that confirms that I have strong behavior. Now, a strong oscillator is not solely a wave 3. Okay? Just because the oscillator is strong doesn't mean it's a wave 3. The market has to also be in that predictive Fibonacci ratio as well. It can't just be a strong oscillator must mean it's a wave 3. No, the strong oscillator confirms what the Elliott's telling us. So I go up here and say, oh, wave 3, is the oscillator strong? It is. Must be a wave 3. Okay? Now during wave 4, what we found through our research and through our testing, we found that 90+% of all historical wave 4s, 90% of the time, when the market identifies itself as a wave 4, this oscillator will retrace back to 0. So if you take a look at the oscillator down here in the corner, when I say retraces to 0, the 0 is the center line. Okay? Right here, 0. See that blue line that kind of formed on there? That is 0. So during a wave 4, this oscillator will retrace back to 0. 90% of the time during all wave 4s that we tested, this happens. All right? Now, that's pretty significant. What we can do from there is say, all right, if 90% of the time all wave 4s, the oscillator return to 0, how many of the times when it retraced to 0 did the wave 4 actually result in a wave 5? Well, here's the second part of the sequence that we found. We found that you have your greatest chance of success for this market to make a fifth wave if the oscillator retraces 90 to 140%. Okay? So when you see this pattern on the chart, you got a nice wave 4 in place, that oscillator's pulled back. What I can do is I can go down there and measure this oscillator, and I can measure it from the starting point where it just started peaking above 0, which is back here on June 17th, and I can extend it to the highest peak of it. And as long as that oscillator during the wave 4 stays between 90, which is this upper level, and 140%, which is that lower level, there we go, between 90 and 140%, this market has the strongest chance of fifth wave development. Okay, so if I watch this market and if this oscillator starts getting weaker and it starts doing something like this and it starts doing something like this, you have a very poor chance of that trend continuing. And most likely what's going to happen is the trend will change. You'll not complete your fifth wave pattern, and the market's going to stall early. And I'll show you an example of that happening on this very chart once we get through the sequences here. Okay? So what we've got here is we've got a wave 4. That wave 4 is in the sweet spot, so to speak. The oscillator's pulled back between 90 and 140. Historically, this market has a very high degree of success for a fifth wave completion. Now, just to make it even more, we had 2 more indicators that are proprietary to AdvancedGet. The first is this little red number right here called the PTI. The PTI stands for Profit Taking Index. And what this index does, it's a number that generates between 0 and 99. Will increase. 36 essentially is the tipping point. 36 and greater is good. That means the market hasn't taken too much off. 35 and lower is bad. That means the market has taken too much profits, and the historic chance of the fifth wave to complete is low. In the case of NextEra, we're at 74. That means we have a good degree of success chance for this trade to develop. And again, just so we're all on the same page, sometimes when I do the demonstrations, it can be a little bit strange because, you know, the market's coming down and people are assuming that we want to sell it. No, we don't want to sell this thing. We actually want to buy this market. This market's going to rally so far to a new high. We expect this market, and you can even see the prediction right now, we're expecting this market to get up to a wave 5 right here at about 103. So even ahead of time, we're putting that fib ratio out there for you so you guys can kind of see it. And you know, one thing I didn't do, I did not see the questions that were popping in. I apologize for that. I'm actually going to look at it right now. There we go. Okay, yep, I kind of answered that question already with the get oscillator, essentially a MACD. Let me expand on that a little bit more. Essentially a MACD, you can say it's essentially a MACD. The difference essentially between an oscillator and a MACD is using exponential moving averages, where an oscillator is using simple moving averages, and a MACD typically has a third smoothing average, where the oscillator doesn't. The MACD has that smoothing average where the oscillator doesn't. Again, nothing wrong with a MACD. We just found that this price oscillator, and again, the price oscillator that we're using, it's not proprietary or anything. It's just a 535 price oscillator. So if you have a system that you work with right now, you know, and you're looking at MACDs, I guarantee, well, I don't want to guarantee, that's a pretty strong term right there, but I am fairly confident that whatever software platform you're using, you could probably do a price oscillator. Just throw a price oscillator up there for 535 and kind of start watching for these sequences that I'm referring to. Okay, it'll even, you know, it'll give you an idea of what the Elliot sequence could be. Of course, you won't have the Elliot numbers and the PTIs and things like that, but you'll at least get an idea of, you know, what can kind of happen here. All right, now I'll talk about divergences too here in just a few minutes. All right, so we've got 3 trading ideas, or 3 trading rules set up here. We've got a wave 4, we've got an oscillator retraced 90 to 140, which is the sweet spot. We've got a PTI greater than 35, which tells us that the market hasn't taken too much off the table. And then finally, our last rule of the type 1 trade, we're going to take a look at these channels right here. We've got a blue channel, a green channel, and a red channel. Now these 3 channels are moving averages, okay? That's all they are. They're moving averages. What moving averages are they? Not really important. Could I figure out what they are? Sure. If I go to my tools and I put in moving averages, I can sync one of the moving averages up to it, and I can tell you that it might be a 22 period or a 38 period. These moving averages are custom created based on the ratios of the Elliott wave that the software is generating. If waves 1 and 2 are a certain ratio, and then 2 and 3 are a certain ratio, and 3 and 4 are a certain ratio, the software does a proprietary algorithm that comes up with 3 moving averages for you to track your wave 4. And what we use these for essentially are probability opportunities. If your wave 4 can stay above the blue channel, which in this case we haven't. We've already broken that blue channel. If your wave 4 can stay above the blue channel, this trade has about an 80% chance of creating the fifth wave. Well, we've already gone past the blue channel, so that's not likely here. If we trade past the blue to the green, now we've got about a 60% chance of a wave 5 completion. Well, that's where we're at right now. We're between the blue and the green channel. We've got about a 60% chance historically of this market creating a fifth wave. Now, a very quick definition of that. That doesn't mean that if you take a trade, you're going to be 60% accurate. The trade could trigger you in, stop you out, and then go up to wave 5. That doesn't mean your trade's going to be 60% accurate. That means the pattern itself is 60% likely if we hold that blue to green area. If it drops between green and red, you now have about a 50% chance of that wave 5 developing. If we drop below the red channel, that means we have less than a 50% chance the market has retraced too far and you should no longer be looking to buy into this pattern. Okay? So what we've done is we've essentially created 3 error checking routines. Wave 4, great. It's a wave 4, wave 5 should be met. Historically, the best wave 5 chances of success have an oscillator pulled back and forth between 90 and 140. If that gets violated, that lessens your likelihood of a wave 5. That's error check number 1. We have one based off profit taking. If the profit taking based on price grows too much and that PTI drops, that decreases your chance of a wave 5 success. If the market retraces in price too much based on the pattern of the market, not just price as in we dropped $4. I'm talking based on the structure of the Elliot sequence. That's what these wave 4 channels are representing, structure. If we retrace too much structure-wise, the wave 5 has a poor chance of success. Based on what I see right here, this is a good potential wave 5 candidate. I would feel comfortable buying into Nextera as soon as we can. Okay? Now this is the key. Trigger. We have a setup here that says we can go long Nextera Energy. The next question is, when do we go long? We're expecting this market to go higher. Okay? That's what we're expecting. You cannot buy a market unless it starts moving higher. We do not buy falling markets. We do not sell rising markets. I don't care what trading strategy you're using. I don't care what platform you have right now. That's something that you should be taking with you to any type of trading system. You do not buy markets when they're coming down. I don't care if you've got 75, and I'm being a little dramatic here. I don't care if you've got 75 indicators telling you buy, buy, buy. If that market is still moving down, you need to wait. Same here. We've got a good type 1 setup that's telling us to buy this market. Not yet. What do we wait for? If you want to be the most aggressive trader that you can be, at the very least, I would tell you, wait for the market to start moving higher. Okay? So I would say, in this example, let me thicken the bars up so they're easier to see for everybody, and I'll spread this chart out a little bit. I would say, at the very least, the high of that for that last bar right there is, let me change my text here to black. I always change that because I want to make it so I can't see it. All right, that did not help me. The high of that bar is about 99.50. Okay, so what I would want to do is I would go into my brokerage software and I would put a buy stop in for this thing, maybe at about 99.60, just a couple ticks above the high of the last bar. Now when the next bar comes in, okay, look what happens. We're still going a little bit lower. The market hasn't responded yet. Next bar, all right, take a look. We're still not moving higher. This bar's high, this bar's high, and this bar's high. We're not making new highs in this little sequence yet. Next bar, all right, at the very, very aggressive trader, you could buy it right here. Okay, that's at a price of about 99.35. And let me extend this a little bit farther so you can kind of see. See how that bar has made a new high? It's broken the high of the previous bar. Right there, this is what I call a bullish or buying bar. Okay, it's going higher. All during this retracement in the wave 4, lower high, lower high, lower high, lower high, lower high, same high, and now finally we've got a higher high. This right here, in conjunction with the fact that we're in a wave 4, the oscillator's pulled back, the PTI is greater than 35, okay? Everything here is pretty much saying go ahead and buy this market now. And the next bar, all right, and then the market starts into its 5th wave. Now, in this particular example, what we are looking for is we are looking for this market to get at a conservative rate to this 5th wave up here at around 103. Now, that little dash mark and a 5 up there, what that is right there is a projection based off of Fibonacci. Now, the software also has some other types of projection tools, one of which is called the MOB. M-O-B stands for make or break. The MOB is a Fibonacci tool that's based off of market sequencing. It's not just based off of 3 to 4, 1 to 2, 1 to 3. It's also based off of rate. It takes a little bit of Gann sequencing and Gann concepts in there. And one of the things that I use when I trade these type 1 trades like on Nextera, I use our tool called the MOB. And the general concept or general theory behind the MOB is if you want to see how high a market can go, use your MOB tool at the last high. Okay? Now when I say the last high, that relates to Elliott wave. So if I want to predict a 5-wave pattern, okay, if I want to predict a wave 5, I will take my MOB from the previous high, which was wave 3. So I'll take my MOB from the wave 3, and there is a profit target that I would use for wave 5. This is a little bit more aggressive profit target. It's a little bit easier to hit, and because it's based off of the structure, the rate, not only the sequencing, but the rate of the market's ascent, it's a little bit more accurate of your wave 5. So as the market approaches that MOB, that's when I'm going to essentially take profits on this position. So right around here is where I'm going to be profitable on this trade. This was on the morning of the 25th. That was where we opened on the 25th, and that was the second bar. This right here is where I would say profitable. Okay? No more, no less. You're getting into this trade right at around 99.35. You're out of the trade at the MOB at about 101.27. Now, if you look at this, right, with an aggressive entry on this sequence, you're getting into this market at about 99.35. You're going to place a stop right below the low at about 99. Okay? So you're risking about 35 cents in this trade to make a couple bucks. That's a really good reward risk. This is a repeatable sequence that happens over time quite often. Okay? And I'll kind of just take the chart out of replay mode. Did this market end up going a little bit higher than that MOB? Yeah, it did. But take a look. I mean, the market hit the MOB on the morning of the 25th, and here we are. We're now at the close of, June 27th, and that market still is radiating really from within that resistance level. So could you have made a little bit more money by waiting for that top to occur at 120 or 102.23? Yeah, you could have, but look at this. It took this amount of time to get to that MOB, to make that big price movement, and then it basically went nowhere and still kind of going nowhere in twice the amount of time. That MOB level is a significant level of resistance for a wave 5. It's something that you should always pay attention to. Okay? Now, I will tell you this, most of the time, probably 80% or greater, if I'm in a trade on a wave 4, I'm going to take profits at that MOB because it's that good of a tool to help you predict market termination. Okay? So that's kind of how the type 1 trade works for this particular sequence. I'm going to try to look at some questions here and make sure. Yes, this is only for eSignal right now. Okay? Only for eSignal. All right. So what I want to do, I want to kind of take you back. What I talked about a little bit earlier was a lot of times when you go back in history, the wave counts will be a little bit different. They won't look the same. Look at this entire sequence. We nailed this pattern right here to trade to this high right here. But what about this sequence? Why couldn't I trade this? Well, you could. Okay, if I go back in replay mode, now I want you to also understand the key sequence of advanced get for these wave 4s is that oscillator pulling back to 0. Take a look right here. This was the June 13th to about the June 16th move. We have oscillator strength, and then the oscillator is coming back down to 0 right here mid-morning on June 17th. If I go back into replay mode right here, guess what? That was also an Elliott wave 4 in history. Okay? You had the opportunity to buy into NextEra also right here on June 17th. Now, if you would have done this, you would have probably gotten in maybe here at a very aggressive standpoint, and you may have gotten stopped out on a trading opportunity before getting back into it right here at about 11:30 June 17th. For about 8 or 9, 10 bars, go sideways. Now you can make the argument that, you know, Ron, it did go higher than that, and it did, okay? But still, we found a pretty darn good sequence from that pattern. Now, if you don't want to get out of the mob because you want to hold out that the market can go a little bit higher, by all means you can do it. I have no problem with that. Use a trailing stop and be protective here. You don't want to give back. I have a general rule when I'm trading. If I have a $100 profit or a $1,000 profit, as a general rule, I will not give back more than half ever. So if I've got a $1,000 profit, I will not give back more than 500 of that, trying to hold out for more profits. So when the market hits that mob, this is a good time for you to move up your target, move up your stops essentially. Okay, good time to move up your stops. So if you want to hold out for those times when we can't get the, when we don't get the entire wave 5 with that mob. Now I want to walk you through something kind of interesting here, because here's what's going to happen. This right here is one of the biggest complaints I ever get about Elliot. Ron, the Elliot count changes. Yeah, it does change. Watch what happens. Oh, it just changed to a wave 4. Why did it change to a wave 4? Because the oscillator essentially demands the change. When that oscillator pulls back to 0, like it did when I showed you that first trade, this right here is a new wave 4 sequence in place. Now what I want to show you is I want to show you that, even with this wave 5 back here, okay, when that wave 5 top is in, you might be thinking, but Ron, you just said during a wave 5 you're supposed to be selling the markets, the change of a trend. Why wouldn't I want to sell it right here? Oscillator. The oscillator is the key indicator for Elliott wave trading. This is the key. During wave 3, I talked about how oscillators have strength. And they do. We see it. We see the strength of wave 3 underneath the oscillator right here. Right here we see it, the strength. The key of wave 5 is this. If that wave 5 has the best chance of this market stopping the trend, wave 5 should make new highs with less strength. This is where the divergence really, really needs to come in. Okay? Divergence means this, different. The market is making a new high. Clearly, we've made a new high in NextEra. Okay? Here's my 3, here's my 5. The market's made a new high. Historically, the oscillator should not make a new high. If your wave 5 oscillator is just as strong as the wave 3 oscillator, this tells you that the trend is not complete. This market is going to probably continue to rally. So what do you do in this case? You buy the pullbacks. Okay? When the market is still showing signs of strength like it is here, even with the wave 5, you have to buy the pullbacks. Now what our software does is it helps you. It says, oh, pullback. That's a wave 4. Buy it. Now, if we go all the way to the end of this market sequence, take a look at the waves 3 and 5. The market in wave 5, now the current wave 5, has definitely reached new highs. Look at your oscillator down here. The oscillator itself has not. Now this pattern on Nextera is indicative of change in trend. So I would say, based on what I see, if this market can get a good solid sell-off, Nextera into next week has a good chance of selling off. And something like this, I would use a tool like a regression trend line or a trend channel like this. And if we can break that trend channel to be a little bit more conservative, if we can get down into the 101 early, 101 area, this market has a good chance to sell off and go lower. That's the type 2 trading strategy, okay, with oscillator divergence. Now, on the same chart of Nextera, I want you to go back a little bit more. Look at these wave counts back here, 3, 4, 5, 1, 2, 3. You're going to look at this and say, oh, that's a wave 4, but the oscillator didn't pull back. That's backfill. Don't worry about what happened in the past. This is about what's happening now. I'm going to go back to my training mode, and I want to jump back to right here. This was back on June 12th at 2 o'clock. I want to take you back to right about here, because here's what you're going to see. You see a wave 4 off of a downtrend. We're expecting this market to sell off back on June 12th, but this is where the warning signs come in and tell you that it might not happen. Remember the rules of the type 1 trade. Rule number 1, wave 4. We've got a wave 4, it's beautiful. Rule number 2, oscillator must be retraced between 140 and 90%. Take a look at your oscillator down here. It's retraced perfectly, it's beautiful, right? We're between 90 and 140. Look at the PTI, it's beautiful. PTI is 56, everything looks great, right? But take a look at your red channel. Based on the structure of this market sequence, we have retraced too far. This is a warning sign. This market has a less than 50% chance of creating a fifth wave at this point. Well, I think we already see on this chart what the difference is, okay? It sold off a little bit, maybe got a couple suckers in there thinking that, oh yeah, this is going to just pull right back to a wave 5 low, but guess what? It never did. The market recounted, you got your wave 3, and that started the sequence coming right back up. There was your buying opportunity, and then I already showed you kind of the second buying opportunity up there. Now, I don't unfortunately have the time in a 1-hour presentation. There's also another indicator in Advanced Get called the XTL, or trend locating, expert trend locator. When you see that wave 4 failure, like we saw down there, give me a second while I make that a little bit darker blue. When you see a wave 4 failure like we saw back here, right in this area, when you see that wave 4 failure and you see those bars turning blue like that, that lets you know that there's a new trend forming, and that tells you that you can possibly buy this. Now, as a general rule, and this is something that we talk about in our education, you never buy on the first blue. You would certainly not buy on this blue, because again, if you're expecting the market to go higher, you need it to start going higher, and this is the second bar is lower. Blue, blue, if you want to buy into this thing, you buy it right here. Okay, the bar turns blue again. The second bar is your trigger. We make a new high. This is where you could have bought into Nextera, because you already have evidence that this wave 4 is not going to succeed into a fifth wave. Where would you get out of it? You can still use that mob tool. There's your target right there, your initial target. And if we get there, I'll just kind of fast forward it real fast into, it eventually hits it for the wave 5, but that's a target that you could have used. You could have been following with the trailing stop. Either way, you've got a sequence there that was identified in the earliest phases, where we rallied from 96 to 98. Now again, this is a 30-minute chart, okay? This is a 30-minute chart, and this is a sequence over the last couple of weeks. But I wanted to show it to you because it's such a great system and how to use it. And then correct, this is e-signal based, so you got to be you have to have the e-signal version 11 or 12. And then the question that popped in there again about the MACD, the oscillator is actually just a price oscillator, 5 and 35. Now it's similar to a MACD. A MACD has exponential moving averages. This is simple. And a MACD has a smoothing moving average, where this one does not. And like I said, I talked about that a little bit at the beginning of the class. Why didn't we use a MACD if a MACD is similar? Because the backtesting just showed a MACD didn't work right. We tried. We tried to get a MACD to match these oscillators, this oscillator concept, but it just couldn't do it. And this oscillator turned out to be the best. And again, The oscillator is one part of the Elliot sequence. You can do this oscillator on pretty much any technical analysis program. It's just a price oscillator. Use a 5-period and a 35-period moving average, okay, and make them simple. And you can kind of duplicate that indicator anywhere. Because that's not really, that's a very key indicator to Elliot to match things up, but it's not, the most important thing. But, take it with you and kind of track that as you're watching the trading systems that you do. All right. A couple things also I want to show you. We talked a lot about, the wave 4 of the type 1 trade. One of the neat features of eSignal, we have a scanner built into our software where I can go in and I can look for these activities. I can say on a 60-minute chart, show me all type 1 trading opportunities. Okay. And there you go. Here are some type 1 trading opportunities. Now that's a lot of them right now on 60-minute charts. I'm going to pare this down a little bit. I want to say I only want to trade things that have $100 a share minimum, and I'll change that maximum price to a little bit higher number. And okay, now I got a lot less. So here are a couple trading opportunities that we can see currently on type 1s. Monsanto on a 60-minute chart. Here you go. Type 1, the oscillator starting to pull back to 0. Good PTI, we're above the blue channel. Athena Health, 60-minute chart. Now the problem with Athena, and one of the things the scanner won't pick up is that red wave 4 channel, so I'd be skeptical on that one. PXD. All right, PXD. This is a Pioneer National Resource. We're in a wave 4. We've got a potential to move up to about 240 bucks. SRE. Okay, right there. That's kind of violated the red channel, so we'll kind of just skip that one and look on. All right, let's see. BLK, it's kind of on its way already. That one, WEX, WEX. I've traded this one before, MicroStrategy. Okay, kind of broke the red channel. But what you can kind of see is we can go quickly through this and we can find some opportunities for quick trades. Here's GWW. This is now on a daily chart. You'll see that wave 4 coming down there. We're testing that red channel. The oscillator's at 0. Put a mob up there. Boom. 275. Now, this one right here is an example of a good type 1 trade setup, Granger. Now, again, we still haven't bought it yet because the market's still declining. Lower high, lower high. If this thing can start rallying up, I would probably want to use a trend line or something for an entry here. If we can get up to about, 260, 258 or so, this thing looks like a good trading opportunity. It just hasn't triggered yet. Okay, it hasn't triggered yet. Price line on a daily chart. Price line actually is already in progress. We would have, gotten into it around 1160. TFX, Teleflex. Okay, wave 4. We are right on that red channel. It's kind of approaching the ending point, but it's right there. McDonald's. Okay, McDonald's is kind of working its way back up to a type 1 into the wave 5. Now, very quickly, another thing that I want to show you, this is something that I do a lot of during the trading day. This on the left-hand side of my screen is what I call the dashboard. Now, the dashboard does essentially the same thing with a scanner, except what you can do with the dashboard is it's meant for tracking a smaller number of stocks or futures or currencies, whatever you trade it with, right? Now, on the left-hand side, I've got these gauges, 15, 30, and 60. These are all looking for type 1 trading opportunities, okay? All type 1 trading opportunities. If the gauge is green, it's telling me it's a type 1 buy. And I can set alerts to this. It can email me and say, hey, Ron, price line's a 15-minute type 1 buy. Get back to your computer and look at it. Now, right now, I don't see any type 1 trades in some of these stocks that I'm tracking, okay? I can change this for those of you that don't want to trade 15-minute charts. I can make that a 1-minute chart. I can make this a 3-minute chart. Make that a 35-minute chart. I can add more gauges to it if I want to see more potential trading opportunities. I do a lot of intraday trading now on options. So these are set to some of the bigger movers, Priceline, Google, Chipotle, and things like that. Up here's UVXY on a 1-minute chart. The gauge is red. It's a type 1 sell. Okay? And what you do is you monitor this really all day long, and as soon as these trades come in, like I said, I can set it, if I go to my properties, I can set those gauges and put alerts on them. Alert when it's a buy. Send me an email and play a sound. And it'll tell me that I got an opportunity to buy or sell a particular item. And as soon as one of these gauges turns up, here's another one. Here's UA, Under Armour. 1 minute chart, type 1 buy. Wave 4, and this thing has a chance to rally to a wave 5. So that's pretty much all you do. You isolate the opportunities. You can let the system find them for you via the scanner, or you can monitor them via the dashboard. Now, I have dashboards set up with all of my trading strategies. Here's a one I use for futures. I trade a lot of 3-minute charts when I do futures. I've got the type 1 looking for 3-minute charts, the type 2. I've got that XTL helping me. There's also another trade called the stochastic. Here's the euro on a 3-minute chart. It's a type 2 sell. Okay? We're at a wave 5 high on the euro. Well, there's no divergence, so that's a little bit scary on that one. Here's ZB. Somebody asked, what's the Elliot sequence on ZB or ZN? Here's ZB. If you look at the daily chart of the bonds, here's your current Elliott wave. Right now, we are in the midst of a wave 5. Now, one thing I will tell you is that the PTI is pretty low. So that means that the chance of actually making the wave 5 is probably remote. So I wouldn't expect bonds to get that rally up to 5. I would expect this thing to start kind of steaming off, and at the worst double top, and just kind of the chance of a wave 5 completion here are kind of low. We're rallying, but to make that big 5 up there are kind of low right now. Yeah, price line on the daily chart was ready for a type 1. Well, actually, even price line on the daily chart is past the type 1. We're already in it, essentially. The wave 4 low came in back here. Now we're pulled back to 0 again, and I would say at the very interim, if we can get a rally, we could get a rally to about 13.15. Okay? But the sequence itself, this is a troubling sequence, because one of the things that you have to be careful of, this is a wave 4, but you look at that oscillator for wave 4. One of the things that we are worried about is if that oscillator during wave 4 pulls back more than 140%, and that oscillator did. So I would say the chances of us getting back to this 5th wave high on price line is probably pretty slim. Seeing that $1,400 targeting, probably pretty slim. And then I'll look at the TNA real quick on a 30, or not TNA, because I'm kind of running out of time here and I don't want to take anybody else's. Here's TNA on a 30-minute chart. We had the 5th wave that occurred on noon at about the 24th, and this right here, it's a little tricky to go through it in 2 minutes, but what we might be seeing here is the beginning of a wave 2, because a wave 2 typically retraces about 62%. This was a 5th wave high. That's in that 62% range. I wouldn't feel comfortable doing anything on TNA unless we get above that high or we sell off below that trend line. If it gets above that high, I could see a new rally, but what I'm kind of thinking is more of 2 and then 3 down this way because of that 5th wave sequence. Don't sell it right now, but wait for it to sell off below that trend line. Now, if the software is something that you're interested in, we do have a special offer. I'll put that up there on the screen for you guys. You can go to our website, advancedgetcom. You can email us or give us a call. The software typically is $39.95. It's a one-time purchase, and then you own it, so it's $4,000. We give you a $700 off option when you attend one of these seminars. With the software, by the way, we do weekly mentoring courses. So every week on Tuesdays and Wednesdays and Thursdays for a couple hours, we're in a real-time room. You're going to be talking with one of our traders, and we can walk you through charts and the different trading strategies. We have a lot of real-time and online classes and everything that you can learn the Advanced Get system through. Okay? All right. It's 3 o'clock, so I don't want to take any more time because we had another presenter coming on, but I want to thank all of you for attending today. I appreciate your attention. And again, thanks to the host here at Real Traders Webinar. Definitely appreciate the putting this together for us, and hope it was of some value and you learned a little bit about Elliott wave trading. So thanks, everyone.
Thanks so much, Ron. And that was some really valuable information. And guys, if you want to check that out, I didn't have one of the Real Trader webinar links created, but you guys could see it's advancedget.com.